Okay, so something I'm looking at this year is buying a home, I guess probably in the next 12 months. The question is it worth it? I know that at some point in the past I made a video saying that I think home prices are overvalued. It's looking like that was the case in a lot of places in the US. Home prices have been coming down. The question is, regardless, I mean, I guess in any given market, is it worth it buying a home? Like, what do you do to decide whether it's worth it to buy a home, regardless of whether it's overvalued or not? The question is, will it be better for you financially over the long run to buy a home now, or to rent for, say, 30 years, which would be like the equivalent of a 30-year mortgage? Because eventually, almost always, the cost of renting a home will continue going up. Like, the cost of renting a home will continue going up, but in the US, you can have a fixed rate mortgage, which doesn't lock your monthly payment for owning a home, but it locks your monthly payment for the mortgage on the home. And so it kind of makes sense that if rent prices continue to go up over a long amount of time, 30 years, and your mortgage payment is going to remain flat, that eventually it might become worth it to buy your own home if you're planning on staying a while. The question is, given the different variables like the price you pay for the home, the price of rent currently, the prices or like property tax, fees, insurance, rate of inflation, interest rate on buying the home, and I guess inflation rate for rent, what actually what does it look like over the long term? Like, how do you put all these things into a model and get an estimate of whether it is worth it or not? Because there's a certain situation where you can imagine it being very close, where buying versus renting doesn't really matter. But you can imagine another situation where it's a really good idea to buy now, and in 30 years you'll be way ahead renting. And I'm making the assumption that if you rent, one, you'll be saving money on renting each month versus buying, because buying not only includes paying the mortgage but also taxes, homeowners association fees, maintenance costs, inflation. Well, yeah, maintenance costs and insurance. I think I said that. So it includes everything. Whereas renting, you're just paying a rental payment and possibly renter's insurance. So that said, I made a chart. Oh yeah, and another thing to factor in is what happens to home prices over time. And I guess I made the assumption that if you rent, then you're investing the money you save by renting. So that down payment, the closing costs, that all goes in as a lump sum into the market. Some investment, which is dictated by what are these variables? Yeah, like rate of return for investing, and also rent starting out would be less than the home owner payment starting out. So you would save that money each month and put that into your investment as well. So this, I guess this spreadsheet kind of is a little bit of a calculator for all of that. So let's just start with a scenario. You have a home cost of $350,000 and a down payment of 20%, that's $70,000. Closing costs of 3.5%, that's $12,250. And so you've got a principal loan of $280,000 you have to make a payment on. You've got 1% property tax annual, insurance, 0.43% maintenance, 1.5%, and so you get all these fees yearly. And so mortgage payment monthly is around $1,700, and then if you add all those other fees up, that comes out to a little above $2,500. And this spreadsheet takes into account this inflation rate for all of your fees. So we're assuming a 5% annual rate of inflation. I know that's higher than inflation has been lately. Let's actually just move that down. Let's just say it's 2.5%, 3%. I don't like that. Why is that? Okay, so 3%, and let's say rent inflation is also 3%. And these two are independent for now. So that includes annual rate of inflation for all these fees is going to be 3%. Annual rate of inflation for rent is going to be 3%. And we're assuming, okay, let's maybe not go that high. Let's start with what I think is a more realistic number, which is around 7%. I think that's like the average rate of return for the S&P 500. And interest rate 6.1%. I think that's about realistic for today's mortgage rates for a 30-year loan. And we're assuming we're paying $21.90 for rent plus any fees associated with that, which I think is mainly just property insurance or renter's insurance. And so you get this, all the calculations happen over here. I'm not going to get into them right now. But they basically are just compounding calculations for all of the inputs that you give it. And the interesting part is the plot of what's happening. So you've got three lines. X-axis is your time in years. Y-axis is, amount in dollars. So blue line is what is your homeowner equity. That means down payment. Well, that's basically given the amount of money the homeowner has put into the home, how much equity do they have? So that's like home valuation. Yeah, basically total home valuation minus what they owe on the home. And all the fees and stuff that they have to pay each month kind of go into the void. Like those don't go into homeowner equity. And so you can see in this case, after 30 years, it would be nice if it showed, but it's a little over $800,000 that the homeowner has in equity, and the renter equity is in red. That's basically, you've got a down payment initially, right? That is your renter equity. So $70,000 plus your closing cost, which you would have saved if you didn't buy the home. So like $82,000. I think you can even see where this data point comes. Okay, so around $83,000 is your renter equity for starting out. So you start out just a little bit ahead. The green line is like the difference between the two. So are you ahead as a renter or a homeowner? So given this green line, you start out ahead as a renter, but you slowly get worse and worse off as a renter. And actually, it might be interesting. I'm gonna see if this looks, okay, it doesn't like that because there's negative values. So we can't really display this on the log chart, but because these are exponentially growing, if we just had red and green as your inputs, then I think it would display fairly nicely on a log chart. I'm not really sure. It doesn't matter that much. The point being that you have a huge advantage being a home buyer in this situation. And oh yeah, one thing I didn't mention was rate of home appreciation, assuming that's 3%. And why don't we go into that right now? 3% rate of home, average rate of home appreciation over 30 years. Let me make sure. Let's see. So the home value would be based off of that. I just want to make sure I actually... Okay, so this is right. I just wanted to make sure I was compounding it right, like monthly at or as a fraction of the years that have gone by. It looks like that is compounding right. But yeah, 3% rate of home 3% rate of home appreciation is maybe a little high given the current environment of prices being overvalued. And I actually looked at what it might look like in different scenarios. So like what I did here was I basically copied Case-Shiller Home Price Index, the monthly rate of price appreciation, and compounded that over time. And I basically started at time, or like the 0 time, so at the start of this plot would be 2006 equivalent of that Case-Shiller Home Price Index. So that assumes that the housing market is about to go into a correction that's a little bit above, I guess that's 25% housing correction at the peak of the correction. So we're assuming we start by losing value on the houses, and then we go up again, and then we come down again, and then up again. And this might be a little more, like, this is definitely more volatile than you would probably expect the housing market to be long term. But this is almost, I don't know if I want to say worst case scenario, because the comeback up here, it includes like the 2020 house price appreciation to like 2022. The point is, it kind of averages out to like what the red line is, which ends up being like around a 1.91% of annual home price appreciation. If you choose a 3% home price appreciation, which is the green line, you see how in one case this ends up being, I think, around 177% after 30 years. In the other case, we're talking 242%. So what's that, 60-70% more appreciation over that amount of time if you go 3% versus 2%. So it makes a pretty big deal. So if we change this to 2%, well, we can just look at this, what it does to the home equity over time. So 3%, you're way ahead. 2%, you're less far ahead of the renter. Let's see if it's 1% over that amount of time. Well, now it's closer to break even. So home price appreciation matters quite a bit. And if you get no appreciation, then you end up coming out ahead as a renter over the 30 years. Let's look at a different scenario. Let's say you're an insanely good investor and you're able to beat this 7% rate of return on your investment. Let's go to 10%. Okay, so now going from 7% rate of investor return to 10%. Actually, let's just go 1% at a time. So 1% is enough to get you pretty close. 2%, now you're ahead as a renter after 30 years. And you could just do like an absurd number. Yeah, if you get 15% rate of annual returns, you're basically, one of the best investors probably ever. And there's no point in buying a home. Just invest that initial sum into the market and let the investment compound over time. So you can see how much it matters. Like the environment you're in matters a lot. And let's say we're ready to expect a big correction in the market. Maybe you could do the same thing. Like, how do you turn a big market correction into an average rate of return? I don't know if it would affect it that much over 30 years. It's really hard to say. I mean, like, the macro environment changes so much. We've got, like, literally in the 70s, you had a decade where the stock market went sideways, like, and that was nominally. So you were way behind if you were investing, and comparing that to inflation, you lost quite a bit of real value in your initial investment if you, I think, at the beginning of the 70s started investing. So it's a complicated environment, like, and that for that reason it's hard to give generic advice that works for everyone. I think in this market, I think a generic, like, the safe generic advice that would work for most people is probably to just go ahead and buy a house. And like, this is assuming current the current housing environment. So, oh yeah, don't think did I do this yet? Yeah, so assuming the current housing environment where a median priced home in my state at least, or in my city at least, is around $350,000. Rent for that, same home would be around $2,200. So you kind of, after 10 years, you're like, if you stay in the home for 10 years at least, then you kind of break even. If you stay in it for more than that amount of time, then you would win as a homeowner. Less than that time, you slightly win as a renter. It's very close before that time. So let's say housing prices were really overvalued. Let's say 450. Does that make a difference? The answer is yes, quite a bit of difference. If your house costs $450,000 now, that brings your monthly payment to almost $3,300. That makes a big difference. That means you're what, 600 and something, I don't know, $650,000, $700,000 ahead as a renter after that 30 years. Okay, that would be more. That would be, 750 plus 150, so like $900,000 difference after that amount of time. So huge difference, right? Just by paying $100,000 difference on a house, that turns into almost $1 million after 30 years. If you say, let's say house prices collapsed, right? Let's see. What's a 20% drop on 350? Okay, so $280,000. If prices dropped $80,000, then you're at a pretty big advantage. And that's only a $70,000 drop in the home price. You're at a pretty big advantage buying now. And you also have rent. Well, okay, you might want to assume rent goes down with that. I don't think it never occurs that rent goes down more than the price of a house. So let's see how much rent went down in that amount or price drop, or see how much okay, so from 2,500 to 2,000. So let's take, what, 500 off the rent, 450 off the rent, let's say. So 1740. So you're still ahead by almost $500,000 buying a house in that scenario. Yeah, so if you're able to wait and you think you're going to get a correction in the area you live in, then probably waiting to the bottom of that correction, or within a couple of years of the bottom, would be a good idea. Now, what the spreadsheet doesn't model is, okay, well, say you're paying $2,000 in rent per month and you want to wait 2 years. That's what, $48,000 that doesn't go towards purchasing a house. So that's something you have to take into consideration too, and that complicates things quite a bit. I wish, let's see, maybe I'll think of a way to add that into the spreadsheet, but right now that's kind of beyond the scope of what I have done here. As I said, this is kind of more looking at current conditions for purchasing. I guess one scenario to look at is, okay, well, let's say yeah, I think that would be good to look at. All right, so I guess in summary, I already sort of summarized it, but I'll summarize it one more time. Whether you rent or buy depends largely on the current housing environment. I think in general, for most people, it makes sense to buy if you plan on staying in the house for more than 10 years. And probably continue renting if you plan on staying in the house for less than that amount of time.